Hello everybody, welcome to my channel. In this video, we are coming to learn how to build a three-statement financial model. Now, what is a financial model? A financial model is a tool that uses historical financial data and assumptions to forecast the financial performance of a business or of an investment. So what we are basically trying to do is we are forecasting the financial performance of a business using historical financial data and some set of assumptions to be able to predict what the business will look like in some number of years to come. So that is basically what financial model does. So financial model is an important tool in financial analysis, and it helps in making decisions about the financial implications of various business strategies or scenarios. It also helps in planning and forecasting, because the financial model itself is a forecast, so it helps us to forecast um, um, the business into the future, so that you can see at a glance what the business will look like in the next foreseeable future. It is also a valuation tool. It helps investment analysts and business professionals to be able to value a business. Since we know what the business is going to look like, it is a tool that helps valuers to value a business and know the worth of the business. And it is also used in equity raising or capital raising. So those are some of a brief overview of what financial models are and what they do, or their importance in dealing with financial issues. All right, so there are various types of financial models. We have the most common one, which is the three-statement financial model, which we are going to look at in this video. We also have the discounted cash flow model, or what we usually call the DCF model. We also have mergers and acquisition, or M&A models. We have budget models. We have scenario and sensitivity analysis. All of those are types of financial models that are undertaken in real life situations. So in this video, what we are coming to look at is everything you need to get started with building a three-statement financial model, the most common financial modeling tool you will find in the commercial banking and investment banking sector today. All right, so let's get started. So since we have defined financial model as a tool that forecasts the financial performance of a business using historical data. So we have our historical financial statements here, and they include the statement of profit or loss for a 5-year period covering 2018 through 2022. And we also have the statement of financial position. We have the statement of cash flows for the years ended. So these three financial statements are the most commonly used financial statements in forecasting a business or in building financial statements. And as the name of the model we are trying to build goes, three-statement financial model. And so we are looking at how to forecast the three financial statements of any business. So there are other statements in the financial. There are other statements which include the statements of changes in equity and then some disclosure of notes to the accounts. But in this case, we are limiting our analysis to the first three, or the three most commonly used or seen financial statements that we have in finance and accounting. Okay, so this is our financial historical financial statements, and we also have our sample work here, what you are coming to build together. So we have assumptions and drivers. We have the statement of profit or loss. We have the statement of financial position. We have the statement of cash flows, and then we also have supporting schedules. So let's see what each of these. So what you're coming to do basically is um, to forecast this business for the next 7 years, covering 2023 through 2030. So this is year one of the forecast or the estimate, year 2, year 3, year 4, year 5, year 6, year 7, and then year 8. All right, so it's actually 8 years of forecast. So we want to see, based on the historical performance of the business, how the business is going to perform in the next 8 years. We are coming to do that using the historical data. So here are our assumptions and drivers. We have the assumptions and drivers for the profit or loss account. We have the assumptions and drivers for our statement of financial position. We also have assumptions and drivers for okay, I see. So that is it. And then we will use these assumptions to forecast the statement of profit or loss, as well as the statement of financial position. And then after that, we will come to our supporting schedules. We will build our supporting schedules before finally using the supporting schedules to complete our statement of profit or loss, as well as the profit of financial position. And then we will use the figures in those two financial statements to build or complete our statement of cash flows. All right, so let us get started, and then we have amazing stuff to cover in this video. So let's get started. So let me name my sheet to 3 statement model, and I want to give my building 3 statement financial model. All right, so we are coming to start. So let's we have all figures are in USD. Let's indicate those stuffs, and also USD. And we also have, let me italize this using Control I, and we would have our years. So the historical data is from 2018. We have that, and I would want to have this and add 1. I hit enter. Now I'm going to copy it to through to 2030. Let's do that and see. Okay, that's fine. And then for our first 4, for our first years are the 4 are the historical data. So those are the actual data. So let me, using Control 1, I would want to format the number. So this is how I'm going to do it. You have the 0 here, that represents our year, and then I'll add A so that it can differentiate these ones from my estimate or my forecast. So I'll highlighting these ones. I'll do the same, but in this case, instead of A, I will use I'll use a forecast, so F, and so that is F. I'll hit enter, and there we have it. And then I will also give it a nice theme color. We have that, and then I also give this one the same different color. See, this. Okay, so we have this setup, and we would have our assumptions and drivers for, we have statement, our statement of profit, profit or loss, and we'll also have statement of financial, statement of financial position. Okay, now let's see the drivers that we'll be having here. Okay, first of all, let us pull our historical data from our historical data tab. So we have our statement of, so I have already written it, so I'll just come here, copy this, and so this is, come here and paste it here, and let me bold it, and I can also copy this, come here and paste this for now, and I'll also have my statement of cash flows. Statement of cash flows. Let me bold this as well. So we are coming to pull the historical data onto our worksheet. So going back to my historical data, coming to copy my data, Control C, Control C, Control V to copy, to paste. Let me resize the cells so they are nicely aligned. And we already have years at our end, so I'm going to delete this. So my figures are supposed to actually start from C 20 right here, but it's starting from B20. Now to be able to see my years, so that this doesn't happen, what I'll do is I'll freeze the panes, so that when I scroll down, or when I'm scrolling down, the years can be showing, so I know which particular year I am working on. So I will click just below my year, go to my view tab, click on freeze panes, and then freeze panes. So when I'm scrolling, you can see that the years are now started, so that I know exactly which year I am dealing with. Okay, so now we want to transfer our data from where it is to their rightful place. So I'm going to cut my data here, click on where it's supposed to be, and then I'll paste it. Okay, so um, that is it. I'm coming to insert some borders here. So some borders here. So I'll insert a border. I'll insert a border. Set a border. Okay, so let's go and pick our financial statement of financial position and also paste in there. All right, so we have pulled our historical data onto our financial model. So we can now start working on our assumptions and drivers. But before that, let me delete this extra data here. So let's work on our assumptions and drivers. So for the statement of profit or loss, so it's our assumptions and drivers. Let me bold it. Okay, that's very nice. So the first assumption is, so we build our assumptions and drivers using the line items in our financial statements. Okay, so the statement of profit or loss account, we have our sales revenue, we have cost of sales, gross profit, SG&A expense or selling general and administration expenses. We have the depreciation expense. We have the depreciation expense. We have interest expense, and then we also have income taxes. So these are what we are coming to use as our drivers for the statement of profit or loss. So we have our sales. So what we'll use to forecast our sales is the sales growth rate. We have our sales growth rate, and then for our cost of sales, we're going to use our gross profit. Now use our gross profit margin. For our depreciation expense or SG&A, sorry. So our selling general and distribution expense or administration expenses, we would have our SG and A, and we are going to do that as a percent of our sales. And then depreciation also follows the same thing. So depreciation expense as a percent of sales, as a percent of sales. So we have this. Let me set my pen here, and then we also have the interest expense. So interest expense is gonna be as a percent of our long-term liabilities, because interest expense is normally on long-term liabilities of the business. Okay, so and then our last expense item is tax. So our tax expense, and it's going to be as a percent of our PBT, which is profit before tax. the sales growth rate for our 2019 financial year is going to be equal to the sales for 2019 divided by the sales for 2018 and then minus 1, and that will give us the growth rate for sales for 2019. Now, the manner in which we calculated it tells us that we cannot calculate for 2018 since we don't have the previous year for 2018. Alright, so and then quickly let us format this area. So let us format the area. I'll use my control 1 and I want to format my as currency and put all negative values in brackets. Also, I want 0 decimal places. Alright, then I'll hit enter. Sorry, let us make it 1 decimal place. So 1 decimal place, and it's going to be a percentage with 1 decimal place. Okay, I've done it for that. I'll do same for using my, so I'll hit F4 to do the same formatting so that the formatting will be copied onto the ones I haven't selected. Alright, so we have 15.8%, and for my gross margin is going to be equal to our gross profits divided by our sales. So I hit enter, and that is 61.7%. And for my SG&A follows the same as our gross profit, so it's going to be the SG&A expense, and this should be positive. So I'm going to put, since this is a negative figure, I'm going to put a negative or a minus so that it becomes positive. Alright, so divided by our sales, and then I'll hit enter. I'll also have my depreciation expense. Now our depreciation is percent of sales, so that is equal to our depreciation expense, which is also a negative figure, so I'll put my minus, so it becomes a positive number, also divided by my sales revenue. And for my interest expense, is going to be equal to my interest expense, negative interest expense on my long-term debts or liabilities. Sorry, this should be, it should have been this divided by that. Okay, and then our tax expense is a percent of our profit before tax, so that will be equal to the profit before tax, so income before income taxes, and that is it, divided, it's going to be our income taxes, which is a negative figure, so I'll put my minus here, and divided by our profit before tax. I'll hit enter, and there we have it. So I'm going to select these and copy to my right using Control R. I'll copy everything. Sorry, let me undo this. So I'm going to copy this, so let me copy it up to here. So I'll use my Control R to copy to the right, and then I'll do same for this, copy to the right using Control R. Okay, So these are our historical assumptions, or these are the ratios we are going to use for our assumptions or our drivers, what we are going to use to drive or assume that sales is going to grow by this amount based on these rates. So this is why we calculate our historical ratios. So usually what we do is, in order to forecast our assumptions or our drivers, we compare these figures to industry ratios, or we look at economic conditions, economic indicators such as inflation, unemployment, and everything that might impact the business, and we use those to be able to have a realistic forecast of our business. But for our analysis, we don't have such, and we are going to simplify the model. And one of the best practices in financial modeling is to make sure your models are as simplified as possible, and then you also break down um, every complex calculation into simple formats so that everybody understands. Okay, so what you're coming to do is you're coming to focus, see how our so you're coming to see how our sales will grow. So if this is our sales, we can averagely we can put 10% here for our sales. So what you are saying is that we are projecting that our sales is going to grow 10% every year for the next 8 years. So looking at our gross profit margin, we can use 62% for that, and also for SG&A we can use 20%. um, Depreciation, for our depreciation we can cap it at 10%. For these, our interest expense, we can decide to use it to cap it at 3%, as we can see. And for our tax, let's do it as 30%. Okay, and in financial modeling, since this is okay, so let's copy our figures to the right first. So I'm going to Control R to copy. Okay, so in financial modeling, a practice is to change the font color of hard-coded numbers into blue. So with my numbers selected, I'm going to, so since we are going to do the same for my statement of financial position, let's extend the selection to this as well, and I'm going to change the font color to blue. Very good. Okay, so as we can see with the historical data, since these are hard-coded figures, they are all in blue. So it is a practice in financial modeling. So let us take note of that. And so we are done with our statement of profit or loss projections. Now let's deal with our statement of financial position, assumptions, and projections. So with this, we have such drivers as, we have our capital assets turnover ratio. We will have um, sorry, we have receivable days. That is going to be on sales basis. We have payable days. Okay, let's we have inventory days. inventory days, and that is going to be on COGS or cost of goods sold basis. We also have our payable days, and that is going to be on also on cost basis. Okay, and then we also have long-term liabilities. So long-term liabilities. Actually, I'm going to put this in LTD, LTL. Okay, so this, let me also underline this as well. All right, so these are our, for the capital asset turnover, that is what we are going to use to forecast our property, plant, and equipment, or what we used to call the PP. So the receivable days is for receivables, inventory. This is for payables. Oops. So this is payables and receivables days. Okay. So these are what we are going to use to drive our statement of financial position. All right. So our capital assets turnover ratio is calculated by our revenue divided by our total plants and equipment. So we will have that, and this is not supposed to be a percentage. So I'll come in to change my data type to a number, and I want it to be one decimal place. Okay. And I'll copy this, format it to the rest of the cells. All right. So let me just come in to copy this to the rest of the cells. Paste special, and I want to paste the format. Okay. And I'll select this and hit Control so I'll select the rest of these, and then I'll hit F4 to repeat the same action. Alright, so we have that. And for my receivable days, it's going to be our accounts receivables divided by the sales multiplied by, okay, so what we are coming to do is we are assuming that there are 365 days in each of the years. So let me insert some couple of, okay, so we have number of years. Well, we have something like number of days in a year, and that's gonna be 365 days. So let me, sorry, Okay, so let me insert some couple of cells or rows. So let me insert some number of rows so that we can be able to shift our workings forward. I'll copy this. I'm going to cut this and paste it here. Okay, that's fine. And I have number of days, and that is going to be 365. And this is also a hard-coded number, so it should be blue. So it should be blue. And I'm gonna copy this to the right. So we have 365 days. All right. So let's continue. So our receivable days is going to be the receivables figure divided by our revenue, total revenue, multiplied by the number of days in a year. So we enter, and that is 18.3. This is number of days, and so it doesn't have to be points. We have to reduce the number of decimals to 0. Okay, that's fine. And I also do same for my inventory days as well as my payable days. Okay, so the inventory days is on cost basis, that is cost of sales basis, and so it's going to be my inventory divided by cost of sales, which is a negative number. So I'll input my negative multiplied by the number of days in a year, 365. That is 73 days. For payables, it follows the same format as the inventory days. It's going to be our payables in our statement of financial position divided by our costs of sales, and that is going to be negative. So let's make it negative so it becomes positive, multiplied by the number of days. Then we have that. Now these figures that I'm calculating are actually ratios in accounting. So these are accounting ratios. Receivable days, that is the number of days it takes for us um, to receive or for customers to pay us back. That is our receivable days. Our inventory days are, we are talking about how long it takes for our inventory to turn over or for our inventory to be sold out. And then the payable days, we are talking about that is how long it takes for us to pay our suppliers after buying on credit from them. So these are actually accounting uh, figures or the accounting ratios that we deal with every day, and they are used for financial modeling or forecasting. So for our long-term liabilities, is going to be equal to the figures we have already. So I'm going to change. So we have that. I'm going to let me format it to 0 decimal place, and let me also make it an amount, 0 decimal places. All right. So I'm coming to select everything here and copy it to the right using Control R. Great. So we have this. So we are having this, and as we did for our statement of profit or loss assumptions, we are coming to do the same for this. So this one we are coming to use um so what we usually do is we can find an average of these figures. So you can say average, and then select all of these, close my parentheses, and hit enter, and that is 3.2. And so you can use 3.2 in your analysis. 3.2 in your analysis. So that is also fine. However, I prefer to go with the last figure here, which is 4.0. So have 4.0 here. This is going to continue to be 18, and let me remove that. This is going to be continuing to be 72 days. These are assumptions. These are the assumptions we are making, and this is going to be 36 days, and this will continue to be 30 days, 30,000. So it's going to be 30,000. I change it to this. Okay, and then I can copy that into the right, and since they are hard, I'm coming to format their fonts color to blue. All right, now we are done with our assumptions and drivers. So these are the assumptions and drivers we are coming to use to forecast or to prepare our financial model. So let's get started. Now what we want to do is to forecast our sales revenue, cost of sales, gross profit, SG&A expense, depreciation expense, interest expense, as well as our income taxes. All right, so we have everything we need to be able to forecast the statement of profit or loss and some figures in our statement of financial position. All right, so let's get started and then we'll see how. So for our 2023 sales forecast, we calculate it as follows. So it's going to be equal to the previous sales multiplied by, I'll open my brackets, and then 1 plus our growth rate, which is 10%. I'll close my parentheses and hit enter. So this is how we expect our profit to grow in the next year. So let me reduce the number of decimal places to 0. Apply the same format to the entire sheet. So all the cells here, need to format them the same way. So it should be currency with 0 decimal places. Okay, and our cost of sales is going to be equal to the revenue multiplied by, I'll open my brackets, 1 minus our gross profit margin. Okay, close my parentheses and hit enter. So the profit is going to be equal to our revenue less the cost of goods sold. Then I'll hit enter. So that is it. I'm going to copy this across. Control R. So let me actually enlarge my, for all of them. So I'm just resizing my columns. They can fit large numbers. All right. So let me also highlight. Sorry. Let me highlight my totals, control B, and I would also insert a border at the top. That is good. And let me also reduce, let me zoom in, let me zoom out, sorry, just so we can see everything clearly. Okay, so that is great. Now we are coming to forecast our SG&A, and for the SG&A forecast is going to be equal to our revenue. It's an revenue basis, so revenue multiplied by the SG&A rate, and that is 20%. Calculates that. This for our depreciation is going to be also on a basis of revenue, so revenue multiplied by our depreciation rate of 10%, and that is it. And we also have equals our interest expense is equal to our long-term liabilities multiplied by the interest rate, which is 30%. We have that. So that is it for our expenses. So these are expenses, so let me actually insert negatives just so I want to format my cells using control 1, and then I want it as a currency, and I want my negative numbers to be in brackets with 0 decimal places. Okay, so nicely formatted. Okay, and then I'll also format this as negative, and this as well. Okay, so we want to calculate our income before tax or profit before tax, and that is going to be equal to our profit minus the sum of our expenses. So the sum of our expenses, and these are these three. Close my parentheses and I'll hit enter. So it's going to be plus, sorry. So that is it. I have plus there, and I'll copy my entire thing using Control R, and also let me highlight this and also insert my border. Alright, then our income tax is going to be our profit before tax multiplied by the profits, the tax percentage of 30%. So we have that, and this is going to should be negative actually. So this should be equal to alt equals, and this time we are calculating just these two together. So this is our profit for 2023. I'll copy these two across. Alright, so let me insert my borders and also insert another border here. Very nice. So we have just forecasted our statement of profit or loss. So this is our forecasted profit or loss statement, and that is it. So for the next 8 years, we expect revenue, our profits to grow from $36,520 to some $71,700 in 2030. So this is how we expect our profit to grow, our profit after tax to grow for the next 8 years. So this is how we forecast our profit or loss statement. So first, we try to establish our ratios, our historical ratios, using our historical financial statements. And based on those ratios, we are able to come up with some assumptions based on our figures, and then also industry trends, economic situations, inflation, and other factors, and then we make our assumptions, and then from there we can use those assumptions to forecast our profit or loss statement. Now the same is going to be done for our statement of financial position. All right, so for our property, plant, and equipment, we are going to use our supporting schedules to be able to, so we don't have we are going to leave it for now. And for cash and cash equivalents, we are going to derive that figure from our statement of cash flows. And also we have accounts receivable, so we can use our accounts receivable days to be able to forecast our accounts receivable. So we have equals, this is what we do. We are going to have our receivable days assumption, which is 18, and we will multiply that by revenue. Now this is also an accounting um it's an accounting ratio, and so what we are doing is just change of subject. So when you actually study this, financial modeling actually deals with solid financial and accounting knowledge. So these are just ratios that we are trying to change in terms of change of subject to be able to derive our formulas. So it's going to be the receivable days multiplied by our revenue, the forecasted revenue, and we are going to divide that by the number of days in a year. So I'll have that. And for inventories, it's going to be our inventory days multiplied by, so it's going to be our inventory days multiplied by our cost of goods sold, and that is this, and then we divide it by the number of days in a year, and we can sum this. So sum, control R, and we have that. Now to be able to, now that we are here, we can actually insert this at the top. So we are saying that this is a check, some form of a check. What we want to do is, if we want to insert a formula that actually confirms that the statement of financial position balances agree. So we are saying that we want to insert a command at the top here that helps us to check if our statement of financial position has actually balanced. So what we want to do is if, so equals if, we want to issue an if statement, and we want to say that if the absolute, so we want to do absolute um the absolute value of the difference between our total assets the difference, so total assets minus our total liabilities plus equity, is greater than 1, we want to return error. So there shouldn't be a difference. If there is a difference, then there is an error. Else, return okay, or let's say return balanced. So we want to return balanced. Oops. So return balanced. So what we are trying to say that if the difference between the total assets and total liabilities plus equity is greater than 1, then there is an error. Else, it is balanced. So I'll close my parentheses and then I'll hit enter. So we see balanced here, and I want to actually format the font size to something else. Let me pick this. Okay, and then also I'll analyze it and then I'll copy it across. So let me space this out so we can see it. So for now, we haven't input any figures in our statement of financial position, so it indicates that it is balanced. So if there is an error somewhere, that is where we will know whether it has balanced or it hasn't balanced. Okay, so let me resize this nicely, then we can continue. All right, great. So we have that. Size 14 and both top and bottom. Then we can also forecast our accounts payable, and that is going to be equal to our accounts payable days, and that is 36 days, multiplied by our cost of sales divided by the number of days in the year. So I have that. Now okay, so I can copy this across, Ctrl R, actually let me increase the font size of this to 14. So because I have a figure for both sides of the equation, of the accounting equation, our model has retained an error because the total of the asset side does not match the total of the equity side. All right, now we want to look at our, so this is our total sum of this. I can click OK and copy this to the right. want to set a border at the top, and we also want to calculate our total now. Our liabilities, or our long-term liabilities, is already forecasted, so we'll come here. These are our long-term liabilities, so I'll just link it, and the total is alt equals that, and then also I can copy this one across, so Control R, and to insert a top arrow. Okay, then our share capital is not going to change, so we have 100, and I'm going to link this 170, and our retained earnings is going to be calculated using a schedule, or the retained earnings schedule. So we are yet to go there, but for now we can say alt equals, actually I want this, alt equals these two together, and I want to make it bold. Then I can copy them across, so we are forecasting the ones that we can forecast at this moment, and our total liabilities will be equal to our total current liabilities plus the total long-term liabilities. So we have the total liabilities, we bold it, and then I can copy it across. Okay, so our total is going to be total shareholders equity. So total shareholders equity added to my total liabilities. Hit enter, and then I can copy these two across, and then I'll bold the two, and I would also select this and insert my borders. So top and bottom, very good. So here we are with our statement of financial position. So the items left are property, plant and equipment, cash and cash equivalent, retained earnings. Okay, so we are going to build supporting schedules to be able to forecast those ones. So we have supporting schedules, and we'll have our PPE here. And for the PPE, what we are going to do is we'll have our balance brought forward, as we have, and then if there are any additions or disposals, we bring them here. If there are any additions we'll add. If there are any disposals, we subtract. And then we also have our depreciation, and then we'll have our balance at the end. Let me highlight this one. Okay, so we have our balance brought forward, and the balance brought forward is equal to the balance in our balance sheet or in our statement of financial position. So that will be equal to this figure here. We have that. And for additions, we have additions to PP, so that will be equal to it is okay. So it is a negative number, so I'll bring another negative to make it positive. So enter 15. Okay, so this balance is actually the balance at the end of the period. So I'm going to cut it and paste it here. And then also we have our depreciation, and depreciation can be found in our statement of profit or loss. So we can also find it here, so I can link it from here too. So we have 19,500, and it's the same thing we have in the statement of profit or loss. So we have our depreciation as 19,500. Okay, now the balance brought forward can be calculated as our balance at the end. We'll add our depreciation, and then we will less our addition, and that is it there. So I can select everything here and copy it across to the right. Okay, the forecast is going to be equal to it's still the balance for 20, the balance brought forward for 2023 is the closing balance for 2022. For our addition is going to be the balancing figure, so we don't do that for now. And then for our depreciation, we have already calculated our depreciation, and that is going to be equal to the depreciation in our statement of profit or loss, depreciation expense, and here we have it. But I'm going to insert my negative just so it becomes a positive figure. Good. And for the closing balance, or at the balance at the end of the period, it is going to be our revenue divided by the capital asset turnover ratio. So capital asset turnover ratio, we have that. And let me decrease them. So the additions will be calculated as the closing balance added to our depreciation, and then we will less the beginning balance, or the balance brought forward, and that is that. And then I can copy my formulas across, and I also want to highlight my profit or loss, my balance at the end, and also insert borders. Using for this, insert borders. Alright, so let's link it. So we have our PP for 2023 is going to be equal to this figure here, 2023, or enter, and then can copy across, Control R. So that is it for our PP. And then for our cash and cash equivalent, it's gonna be okay. So before we continue, let us actually change our set another rate. So let me change my freeze panes so I can see my balance and then my errors. Okay, so I'll go to my view tab, freeze panes. Let me unfreeze the panes and then freeze the panes back so I can see. Oh, sorry, I clicked at the wrong place, so I want to click here, freeze panes, unfreeze panes, and then I'll freeze the panes back just so I can be seeing my balance and then my error. So let's continue. All right, so as I was saying, the cash and cash equivalent are going to be gotten from the statement of cash flows. So I can copy these figures across, copy them across, and then the next thing we want to do is the retained earnings. So let's look at our retained earnings schedule. Or the retained earnings accounts, or a statement of retained earnings, and we would have our balance. So we have our balance brought forward, we would have dividend. All right, so let's actually we have profits, profit for the year, we have dividend if any, we'll subtract the dividend, and then we'll have our balance at year end. Okay, do this as well. So our balance at the end is going to be gotten from our statement of profit or loss, our statement of financial position, sorry. So we have our statement of financial position, retained earnings. So we have it here, and then I'll highlight it, or let me bold it, and then I can copy it across. Great. Then dividend. Is there any dividend? We can check that in our um, statements of cash flows. We don't have any dividends. So we don't have any dividends, so I can actually remove the dividends column. So I'll go to the home tab, and then I can click delete to delete our, and then we have our profit for the year, and we can get that from our statement of profit or loss. So our profit for the year is the profit after tax. So our profit after tax, which is right here, I'll enter it. Then our balance brought forward is going to be this sorry, do that. So this is going to be equal to our balance at the end minus our balance, our profit for the year. That will be 0. So I can copy this across. Okay, Now we have everything working perfectly. So let me actually insert my border first. Borders here. So we have everything working perfectly. The balance for our 2023 brought forward will be equal to the ending balance for 2022 as we have it here, and for our profit for the year we can actually have it, copy it from here to here, and we add those two together. So we can sum those two together. So alt equals and then equals this. So let me bold it, and then I can copy the formula across. So Control R, we have that. Alright, so now that we have our figures for retained earnings, we can also insert our retained earnings figures. So for 2023 retained earnings is gonna be equal to this figure right here. So I press enter and then I can copy it across. Alright, so we have everything set up. Now the only balance left for us to insert is our, so set a border here. So the only balance left for us to insert is the cash and cash equivalent, and that is gotten from our statement of cash flows. So let's complete our statement of cash flows and then we can see what happens. So we have our profit after tax that can be gotten from the retained earnings here, and we also have, what we do is that we have depreciation expense which should be added back. So this can also be gotten from our schedule. So depreciation expense is here, and we also have our changes in non-cash working capital. So for our changes in working capital, we are coming to do it under this. So we have changes in working um, um, capital. So for our working capital, we are talking about a receivable. And while I have our accounts receivable, accounts payable, as well as our inventory. So what we are looking at basically here is the changes that are occurring, or the movement that is occurring in these figures. So historically, let's look at it. For 2022, our accounts receivable will be equal to, I'll bring my brackets, and would have so I'll bring my brackets, and we would have our accounts receivable and then minus 0 because we don't have a previous year. So minus 0, and then I'll hit enter. Now accounts receivable is increasing. Whenever accounts receivable is increasing, it means that our customers are not paying us, and so that's a drain on cash. So it will actually reduce our cash. So whenever accounts receivable is increasing, it's is indicated as a negative figure in our statement of cash flows. All right, so we have that. Okay, so for our accounts payable is going to be the opposite of accounts receivable. So whenever accounts payable, sorry, is increasing, it means we are actually holding on cash, and so it increases our cash position. And so we have our accounts payable here, and then I'll subtract 0 because we don't have a previous year for 2018. And for inventory, it works as with so the more inventories you hold, it means we are not selling, and so our cash is locked up in inventory. So whenever inventory is increasing, our cash is being drained. So we have so I'll bring my minus, is the drain on cash, and so minus has to be there, and we have inventories right here, and then I'll subtract my 0 because we don't have a previous year. And what I'll do is I'll sum those three together, and we have control B. Then for my second year, it's gonna be equal to um, accounts receivable for this year, and it is increasing. So when it's negative, then it's a negative. So let me actually input my negative, and I'll also open my brackets here, and then minus this. So our account receivable is increasing, so it's a drain on cash and our cash position. For accounts payable, let's see, accounts payable has also increased, but that is actually a good sign for us because we are not paying and we are holding on to our cash. And this will be equal to, for inventory, sure, it's also increasing. So let me put my negative sign and open my parentheses, and I will have this minus the previous year, close my parentheses and hit enter. And then I can copy my formula across here. So now I can copy my entire work across the rows of data. So copy it across, and there we have it. So we have our changes in equity, our changes in working capital. So can come here. So my change in working capital for 2023 will be equal to 2023 forecast period will be equal to this. So I have it there, and then we have equals, and I'm going to sum all of these together. So sum, and I'm going to sum all of these together. Let me bold it, and then can copy them across. And I want to insert my border at the top. Great. Then we also have our additions. Our additions to PPE can be found in our PP schedule. So we have PP here, additions. So I'll link it here, and this is supposed to be a negative number. So negative, very good. Then I can copy it across, and this, let me actually add it. Alt equals this, and then let me bold this, insert my border, and then I can copy it across through R. Now we have payment of debt. We are assuming that we are not going to pay any debt, so debt repayment will be 0. So can have equals this previous amount here, and for our, it's supposed to be a currency, it's supposed to be currency with 0 decimal places. All these, so all of these are supposed to be currency. So let's quickly format those. So hitting Control 1, I'd like to my settings 0 decimal places with my negative numbers being in brackets. That's very good. Okay. Since it didn't work, highlight the entire sheet here. Control 1, come to currency, 0 decimal places. That is fine. Great. Okay. For issuance of equity, we are assuming that there will be no issuance of equity within this period, that the number of equities we are having is enough. So equals, now this particular financial model is a standardized one that we want to use. So with this, you can be able to actually do any 3 statement financial model that you want to do. So this will set you up for any financial model you want to undertake. So we want to copy that across, and finally we can do our final calculations. So we have the cash used for the period, and that will be equal to our cash generated from operations added to our cash used for investing added to our cash used for financing activities. So I'll have that, and we'll have our cash and cash equivalents at start. Our cash and cash equivalents at start will be equal to the cash and cash equivalents at the beginning of the previous year, at the end of the previous year, sorry. So we would have this, and then we have alt equals these two together. Then I will press enter, and then I can copy the formula across. So across, and let me highlight this, bold it, and then I can use it to determine if my balance statement of financial position would balance or not. So this is equal to my cash and cash equivalents at the end, enter, and there we have it. It has balanced. So I can copy everything across, Control R, and we have it balanced. So what you want to do is you want to add some finishing touches to our work. So we want to group these things together. And what do I mean by that? So you can actually, let me highlight this. Let me add color, a fill color. Let me add, I want to make it this blue, and coming to highlight all of these, and then I'll use F4 to repeat my action. Highlight the this, and I'll use F4 to repeat the action. Highlight this, use F4 to repeat the action, and the last, okay, this is supporting, supporting schedule. So I have a supporting schedule. I'm gonna highlight this and hit F4 to repeat that. Good. Now what we are coming to do is we want to group this together. We want to group the rows of data together. So I'm going to highlight the whole of our assumptions up to here, and then I'll go to my data tab and go to outline, and then I'll say group, so that I can actually hit this to group it. Very nice. And then I'll select this as well, all of this as well, and then hit F4 to repeat the action, and then I'll group it. I'll come here, select all of this, holding my shift key I can select everything together, and then I'll press F4 to group everything together like that. And then lastly, for my cash flow, okay, that's not the last, sorry, holding my shift key can press this, sorry, holding my shift key I can select all of this, and I'll press F4 to repeat that, and I'll collapse it. And then my supporting schedule, so select this, selecting F4 to repeat that. Great. So this is an overly simplified financial model that you should practice in order to get started with financial modeling. So what do I have to offer, or what final words do I have for you? I would advise that you look into your financial ratios, because everything here we did was to calculate financial ratios that served as a basis for projecting into the future. So when you look at the assumptions and drivers, so let me collapse everything. So when you look at the assumptions and drivers, we actually calculated accounting ratios, and we used that ratios to forecast into the future. So this is how you build a very nice three statement financial model, and I believe that you have learned a lot. And I also know that this has been a very long journey, but you should be comfortable whenever you sit to prepare any financial model. I will be leaving the historical financial data in my the video description so you can download it and then practice along. So thank you very much for your time, and I hope you have learned a lot. And consider subscribing to the channel, because I'll be doing more of this. I'll be doing sensitivity analysis, I'll be doing the DCF model, and also I'll work on more advanced financial models in my on my channel.